we are going to run a series of videos that busts the jargon that you may have seen or heard when dealing with letting agents and estate agents. So the first one is tenancy agreement. A tenancy agreement is a contract between a landlord and a tenant that sets out the legal terms and conditions of a tenancy. A tenancy can either be periodic, which is running on a week-by-week or a month-by-month basis, or for a fixed term, which would run for a set period, say 6 or 12 months.
An assured short-hold tenancy, otherwise known as an AST. An assured short-hold tenancy is the most commonly used tenancy agreement and is usually for a fixed period of 6 or 12 months. This agreement sets out yours and your landlord's rights and responsibilities during your tenancy agreement. When an assured short-hold tenancy ends, provided the tenant remains in the property, it will continue as a periodic tenancy, unless that tenant signs a renewal agreement.
A renewal. At the end of a fixed term tenancy, tenants and landlords can choose to renew the tenancy for another fixed term. Although it's not essential, it does, however, provide long-term security for both landlord and tenant. Landlords may ask a tenant to sign a renewal if they want to change the terms of a tenancy agreement, which could include raising the cost of the rent. A break clause. A break clause is a provision that's built into a tenancy agreement which enables either landlord or the tenant, or both, to end the tenancy early. An absent landlord. So when a landlord is described as absent, it means they cannot be contacted directly. In this case, the managing agent or letting agent would be the first point of contact.
Credit search references. Before signing a tenancy agreement, you will be referenced by your letting agent or your landlord. Many agents and individual landlords use external companies who will undertake a credit and affordability check along with employee and landlord references to confirm your employment details and your salary. On many property portals, you will see that there is either a PW or a PCM next to the price. What this means is it's the frequency of the rental payment. So PW being per week and PCM being per calendar month.
A guarantor is someone who agrees to sign a tenancy agreement, effectively guaranteeing that they will undertake the full obligations of your contract on your behalf if you default on your obligations under the agreement. If for some reason you cannot pay the rent, the guarantor would be responsible for making these payments. So the deposit or security deposit, landlords will ask new tenants to pay a tenancy deposit to cover any future damage to the property or unpaid rent. The deposit can be equal to up to 5 weeks' rent in England. Landlords in Wales, Scotland and Northern Ireland may charge more.
Holding deposit. This is a refundable sum of money that you pay to either the landlord or the letting agent to reserve a rental property before signing the tenancy agreement. If you decide to withdraw your application for the tenancy, this is normally non-refundable. If the tenancy goes ahead, then the amount that you paid for the holding deposit is usually deducted from your first month's rent.
Inventory and schedule of condition. So this is a checklist of the current contents and condition of a property which is undertaken to ensure that the property is left in the same condition in which it was originally let. It can cover cleanliness and the state and age of fixtures and fittings such as plug sockets, furniture and windows, etc. At the start of a tenancy there should be an inventory to check in, and then again at the end of a tenancy a check out. Agents and landlords may use an independent inventory clerk to carry out the inventory.
Client money protection, otherwise known as CMP. This is a scheme that protects money paid by the tenant to their letting agent or landlord. It is important to note that CMP is a legal requirement and all agents and landlords must be covered. By using an ALA Property Mark protected member, you can guarantee that your money will be safe.
So tenancy deposit protection, otherwise known as TDP, your landlord must register your deposit with one of the 3 government authorised schemes. You've got the DPS, which is the Deposit Protection Service, My Deposits, or the TDS, which is the Tenancy Deposit Scheme, within 30 days of you paying it. That's 14 days in Northern Ireland. They must also give you details of which scheme is used, your tenancy deposit protection certificate and additional information known as the prescribed information. And this explains how you get your money back at the end of the tenancy and what to do if you or your landlord disagree on the amount to be returned.
Redress. If you have a dispute with your landlord, the case can be referred to a neutral expert to resolve. This is known as redress. All letting agents are required to sign up to a property redress scheme, so make sure you note down which scheme your agent is registered with. Arla Property Mark licence members in England and Wales will belong to either the Property Ombudsman, the Ombudsman Services Property, or the Property Redress Scheme. Arla Property Mark licence members in Scotland fall under the remit of the First Tier Tribunal for Scotland, Housing and Property Chamber.
Sublet. Subletting is where a tenant lets part or all of their rental property to someone else. You must have permission from your landlord before subletting a property. Otherwise, you could be in breach of your rental agreement and your landlord can take legal action against you. HMO. This is a house in multiple occupation. HMOs are properties which house tenants from 2 or more households with shared facilities such as a kitchen or bathroom. Large HMOs, more than 2 floors and more than 4 people, need to be licensed. Okay, so common parts are any part of a property, land or premises, which are part of a shared facility, for example a shared entrance or garden. This is mostly applicable when you're dealing with flats.
Managing agent. It's an agent or a company who is responsible under an agency agreement for the maintenance and management of the property. Not all properties are professionally managed, so your landlord may be responsible for the maintenance of the property.
Fixtures and fittings. These are items that are usually included in a rental property, such as curtains, carpets, blinds, light fittings, kitchen units and appliances. In some cases, it may include furniture. It's advisable to check what is provided prior to signing a tenancy agreement.
Dilapidation. This is damage to a property or contents that is considered to go beyond acceptable wear and tear. Notice period. This is the period of time that a tenant or a landlord must give to end the tenancy agreement. Arrears. This is unpaid rent that is overdue or outstanding.
Okay, so let's have a look at some of the terms and phrases that you may come across when dealing with the sale or purchase of a residential property. So first off, we've got a buyer. That's the person that's buying the property. The seller is someone that's selling the property. The vendor is also another term for someone that's selling a property. And a first-time buyer. This is an individual who's never bought or owned a property before. Renting a property does not count as buying or owning. Freehold. This is a type of occupancy which means you own the building and the land it sits on. Leasehold. This is where you own the property but not the land it's built on. For example, you may own a flat but not the building it sits in. Common hold. It's an alternative system to leasehold, usually in place in buildings or estates of multiple occupancy, such as a block of flats, whereby you own the freehold to your property and all property owners collectively help manage the upkeep of the building or estate. Your deposit is a set amount of money which acts to secure a purchase, usually a low percentage of the full price. Paying this usually means you're committed to going through with the purchase and will pay the rest off at a later date. Mortgage is a loan of money used to pay for a property, which you pay back over a time with interest to whoever lent you the money. The property itself is considered collateral, which means if you don't keep up with your repayments, it can be seized and sold to make back the money. Interest rates is a charge added to the amount you pay back on a loan, written as a percentage. For example, a mortgage with a 4% interest rate would mean you have to pay back the full amount of the loan plus 4% of its value. An agreement in principle, also known as a decision in principle, a mortgage in principle, an approval in principle, or a mortgage promise, is an estimate of how much money you can borrow from a mortgage lender for a mortgage. Based on your income and credit history, this agreement can be used to help you get a mortgage or to have an offer accepted on a property. Execution only is when a consumer, a buyer, chooses to mortgage themselves rather than taking advice from a lender or a mortgage advisor. ERC, this is the early repayment charge, a charge given when you overpay on a mortgage or transfer to a different mortgage product during a specified amount of time, known as the early repayment charge period. The charge covers potential lost interest to your lender. SVR, this is the standard variable rate, the rate your lender charges after your initial mortgage deal finishes. The rate is set by your lender, not by the Bank of England, and your lender can change that rate at any time. APRC is the annual percentage rate of charge, the total rate of interest you'll pay for a mortgage's entire duration. This considers all the different rates your mortgage will be subject to and acts as an easy way of comparing mortgages. Lower rates usually means a better deal. LTV is loan to value, the ratio of how much your loan will cover the price of your property, written as a percentage. For example, a mortgage that offers a 60% LTV will cover 60% of the property's price. A bridging loan is a temporary short-term loan which enables a buyer to purchase a property before selling their existing property, most commonly used at auction. Equity. Equity or capital represents the amount of money a homeowner has put into a property. This value is built up over time as the owner pays off more of the mortgage and the market value of the property appreciates. Surveyor. In the context of property, they're a qualified expert who specialises in examining and highlighting any potential issues or benefits within a property that may affect its price or need fixing in the future. A building survey is a report into the physical state of the property. This also sometimes referred to as a full structural survey. A covenant. A covenant is a provision or a promise that has been written into a deed, which may affect or limit the use of the property or land. There are two different types of covenant, positive and restrictive. A positive covenant is an obligation which requires some form of action, such as maintain a fence or a wall, whereas a restrictive covenant limits or prevents the use of land in a specified way. An easement is the right of one landowner to make use of another nearby piece of land for the benefit of their own land. For example, a private right-of-way. A chain. A chain is formed when several property sales and purchases are interdependent. A chain can be complicated, but a good estate agent will be able to help keep it moving. EPC. This is the Energy Performance Certificate, and it shows the efficiency of a property and gives an indication of how much the bills will cost. It's displayed in two graphs, the energy efficiency and the environmental impact of the property. Each is graded from A, the best, to G, the worst. Under offer. If a property is under offer, it means that the seller has accepted an offer from a buyer, but the contracts have not yet exchanged. Gazumping. When a higher offer is made by another party and is accepted, sometimes even after the offer with the first buyer has been accepted. Gazundering. When a buyer lowers their offer price, usually at the last minute, so the seller has to accept the lower price or reject it and risk having to find another buyer. Exchange of contracts. The point where both parties are committed to the transaction. Both the buyer and seller can walk away at any point before the exchange of contracts. Conveyancer. This is a solicitor who specialises in the transference of home ownership. They are required if you're using a mortgage, and they will cover every legal aspect of the home purchasing process. The solicitor is someone who deals professionally with legal matters, also known as a lawyer, and holds the recognised qualification or a degree in law. Title. This is the legal right of owning a property or land. Deeds. Documents that show who owns the title of a property or land, along with any burdens, obligations, responsibilities on a property. For example, what you can or cannot alter on the property, any access and rights of way on the property, usually held by the mortgage lender until you pay off your property, where it can be held by you or your solicitor. Land Registry. This is the government's database of who owns what property and land. Be aware that there are separate registries for Scotland, Northern Ireland and the rest of the UK. New build. Usually this refers to a property that hasn't been purchased or lived in and has recently been built. However, different banks and lenders have different definitions, which can vary whether the property has been lived in but not bought, whether it has been converted or refurbished, or whether it has been finished within a certain amount of years. Completion date. When the transaction is complete and the ownership of the property passes from the seller to the buyer, normally the vendor solicitor will ask the estate agent to release the keys to the buyer at this time. Snagging. Snagging is where the developer of a new build property touches up paintwork, adjusts appliances and fixes any other faults within the property. A snagging survey is usually completed prior to the buyer moving in order to get and spot minor cosmetic issues and check the quality of the workmanship. Standard security. Now this applies to Scotland. This is the form that confirms that your mortgage lender, that they can repossess your home if you don't keep up with your repayments. Stamp duty. It's a lump sum tax that anyone buying a property or land over a certain price in England, Northern Ireland and Wales must pay. The current threshold for residential properties is $125,000 and $150,000 for non-residential land and properties. However, the rate you pay will vary depending on the overall purchase price. Land transaction tax. Land tax replaced stamp duty in Wales from April 2018. Buyers looking to purchase in Wales will be charged the land transaction tax on any residential purchase above $180,000 and above $150,000 for non-residential purchases. However, the price you pay varies depending on the overall cost of the property. Land and building transaction tax is a tax you pay when purchasing land or property in Scotland. The current threshold is $145,000 for residential properties and $150,000 for non-residential land and properties. However, the rate payable is subject to the total purchase cost. Base rate. The interest rate, which is set by the Bank of England for lending to other banks. It's generally used as a benchmark for the interest rate banks charge when lending money to customers. Fixed rate mortgage. With a fixed rate mortgage, you pay a set rate of interest on your mortgage for a fixed period of time, so you know exactly what you'll be paying each month. Tracker mortgage. This is a mortgage with an interest rate linked to the Bank of England rate or another base rate. The interest rate will go up and down depending on this rate, irrespective of the mortgage lender. A variable rate mortgage. With a variable rate mortgage, the interest rate can change at any time. They're partly influenced by the Bank of England base rate, but other factors can come into play as well. The interest rate you'll pay on a variable rate mortgage can change, even without the base rate moving, and similarly, the base rate might come down, but your mortgage stays the same. An offset mortgage is a mortgage that allows you to pay less interest if you link it to a bank account with savings in it. And a fixed rate deal. It's a term used to describe a mortgage that has an interest rate that stays the same for a fixed period. The interest rate will not change during that time.